Did you know that $128 trillion is invested in bonds worldwide? That's more than double the value of global stock markets. Yet, most people barely know what bonds really are. If you're serious about growing your wealth and minimizing risk, understanding bonds is a game changer. But here's a shocking truth. Most investors overlook bonds, thinking they're boring or too complex. The reality? Bonds are one of the most powerful tools for building a stable, long-term investment strategy. And if you know how they work, they can actually help you beat inflation, create a steady income, and diversify your portfolio, without the rollercoaster ride of stocks. In this video, we'll break down everything you need to know about bonds, from how they work to the best strategies for using them to grow your wealth. Stick around, because we're about to reveal how bonds can be your secret weapon for financial success. Ready to uncover the hidden world of bonds? Let's dive in. Chapter 1. Bonds 101. The secret behind fixed income investing. Bonds are often seen as the safe investment. They're not as flashy as stocks, but they can be just as important. So, what exactly are bonds? In simple terms, a bond is a loan that you make to a government, city, or corporation. In exchange for your money, the issuer promises to pay you back the principal amount after a set period, plus interest. For example, when you buy a U.S. Treasury bond, you're lending money to the U.S. government. In return, they pay you interest on that loan. But why do people buy bonds? Well, bonds are often less volatile than stocks, providing a more predictable return over time. They're the backbone of fixed income investing. One of the most appealing features of bonds is that they offer predictable payments. Interest, or coupon, payments are paid regularly, often every 6 months. This makes bonds a popular choice for investors looking for a steady stream of income, especially retirees or those who want to avoid stock market fluctuations. Think of bonds as the stable foundation of an investment portfolio, while stocks are the higher risk, higher reward elements. The bond market is enormous. Over $128 trillion is invested in bonds globally, making it a crucial piece of the financial puzzle. Chapter 2. The anatomy of a bond. What's inside? Now that you understand what bonds are, let's break down the anatomy of a bond. There are a few key terms you need to know to fully grasp how they work. 1. Face value. This is the amount you'll be repaid when the bond matures. 1. For example, a $1,000 bond will pay you back $1,000 when it matures, plus interest along the way. 2. Coupon rate. This is the interest rate that the bond issuer agrees to pay you. 2. A bond with a 5% coupon rate means you'll earn 5% interest on the bond's face value every year. 3. Maturity date. This is the date when the bond issuer has to pay you back the face value of the bond. 3. It could be anywhere from a few months to 30 years. 4. Issuer. This is the entity that issues the bond, such as a government or a corporation. 4. The risk of investing in a bond largely depends on the issuer's ability to repay the loan. These terms are the building blocks of every bond. Understanding them is essential for assessing whether a bond is a good fit for your investment goals. As you dive deeper into bond investing, these concepts will become second nature. Chapter 3. Bond pricing. The art of finding undervalued gems. Bond pricing can be tricky, but once you understand the basics, it opens up a world of opportunities. When interest rates rise, the prices of existing bonds generally fall. Why? Because new bonds will offer higher interest rates, making older bonds less attractive. Here's an interesting fact. Bond prices are inversely related to interest rates. So, if you think interest rates are going to rise, you might want to avoid long-term bonds. On the flip side, if you believe interest rates will drop, bond prices will rise, making them more attractive. This presents a unique opportunity for value investors. Just like in the stock market, bond investors can look for undervalued gems, bonds that are priced lower than their true value. These could be bonds from issuers that are improving financially but haven't been recognized by the market yet. Another factor affecting bond prices is the bond's credit rating. A higher credit rating means a lower risk of default, which typically results in a lower yield, interest rate, for the investor. However, a downgrade in a bond's rating can lead to price drops, creating potential buying opportunities for savvy investors. Want to learn more about bond pricing and how to find those hidden gems? Make sure to subscribe and stay tuned for upcoming chapters. Chapter 4. Risk and Reward. Can bonds beat inflation? Bonds have long been considered a safe investment, but can they really protect you against inflation? It's a key question for value investors. Many investors turn to bonds for stability, but the risk of inflation eroding returns is very real. The good news? Bonds can help manage inflation risk if you know how to use them effectively. When interest rates rise due to inflation concerns, the prices of bonds typically fall. This is because new bonds issued offer higher yields, making older bonds less attractive. But there's a strategy to navigate this. One way to protect against inflation is by investing in inflation-protected bonds like TIPS, Treasury Inflation-Protected Securities. These bonds automatically adjust their principal with inflation, ensuring your investment keeps up with rising prices. According to data from the U.S. Bureau of Labor Statistics, inflation averaged 3.22% per year over the past decade. Over time, inflation can erode the purchasing power of your returns, but TIPS can help maintain that purchasing power. Another strategy involves focusing on longer duration bonds. While they are more sensitive to interest rate changes, they can provide higher yields that outpace inflation in a strong economy. However, the risk is that they also carry more volatility. So, balancing between short-term and long-term bonds is key for risk management. The key takeaway is that bonds are not a one-size-fits-all solution to inflation. You need to carefully consider the type of bond you're investing in, the duration, and the market conditions. As Warren Buffett famously said, the first rule is not to lose money. The second rule is not to forget rule number 1. In the context of bonds, this means being cautious about inflation risks and diversifying wisely. Chapter 5. Bond Ratings. Decoding the rating agencies. When you look at a bond, one of the first things you should check is its rating. Bond ratings are assigned by independent agencies like Moody's, S&P, and Fitch to assess the creditworthiness of the bond issuer. These ratings can help you gauge the level of risk involved in purchasing a particular bond. The higher the rating, the less risky the bond, typically. Bonds are rated on a scale from AAA, highest quality, to D, in default. An AAA-rated bond is like the gold standard of bonds, offering a low risk of default. These are typically issued by financially stable governments and large corporations. On the flip side, a BB-rated bond or lower is considered a junk bond, which comes with a higher risk but also potentially higher returns. It's essential to understand that bond ratings are not set in stone. They can change over time based on the financial health of the issuer. For instance, in 2008, many high-rated bonds saw their ratings downgraded due to the global financial crisis. This can directly impact the price of the bond and the yield investors receive. In the world of value investing, assessing bond ratings is much like evaluating stocks. A value investor looks for mispriced opportunities, bonds that are undervalued because the market hasn't yet realized the issuer's improving financial outlook. A downgrade in a bond rating can signal an opportunity to buy if you believe the issuer's financial situation will improve. To really understand a bond rating, you should look at the factors the agencies consider: the issuer's debt levels, cash flow, and overall economic conditions. For example, in 2023, the U.S. government's bond rating was downgraded by Fitch, signaling concerns about rising debt levels. However, Treasury bonds are still considered one of the safest investments in the world. If you found this helpful, don't forget to subscribe for more expert insights into bonds and investing. Chapter 6. The Bond Ladder Strategy. How to build a steady income stream. If you're looking for a more predictable income from bonds, you might want to consider the bond ladder strategy. This strategy involves purchasing bonds with different maturity dates, allowing you to spread your risk and create a steady stream of income over time. The idea behind a bond ladder is simple. Instead of buying a single bond and waiting for it to mature, you buy several bonds with varying maturities. For example, you might buy a bond that matures in 1 year, another that matures in 5 years, and one more that matures in 10 years. As each bond matures, you reinvest the principal into a new bond, extending the ladder. Why does this strategy work? One of the primary benefits is reduced risk. If you only own one bond and the issuer defaults or interest rates rise, your entire investment is at risk. With a bond ladder, you're always holding bonds with varying maturity dates, so you reduce the impact of any one bond's performance. Plus, if interest rates rise, you're reinvesting the proceeds from maturing bonds into higher-yielding ones. In fact, according to a study by Morningstar, bond laddering has been shown to outperform bond funds in terms of risk-adjusted returns. A study on bond ladders revealed that investors using the strategy had lower volatility and were less impacted by interest rate changes than those who invested in long-term bonds or bond funds. Another reason the bond ladder works well for income investors is the predictability it provides. As bonds mature over time, you know when you'll receive your principal back. This predictability makes it easier to plan for future expenses or reinvest the proceeds. One of the most powerful aspects of bond laddering is its flexibility. If interest rates are rising, you can reinvest into bonds with higher yields. If the market becomes volatile, your bond ladder provides a cushion, as maturing bonds allow you to adjust your position without locking yourself into a long-term bond with poor terms. In summary, the bond ladder strategy offers a way to generate consistent income, spread out risk, and adapt to changing interest rates. It's a strategy that aligns perfectly with a value investor's mindset, focusing on long-term stability while generating predictable returns. If you enjoyed this content, make sure to subscribe for more valuable insights on bond investing and building wealth.